Ladies and gentlemen, this is Barry Norman on behalf of FXVC, one of the world's leading providers of Forex and CFD trading, and they are the sponsors of tonight's class. They offer competitive spreads. They're fully regulated in the EU by CISIC, and they have every client is assigned a relationship manager, and they provide support in all language or multiple languages. They give you trading alerts directly on your platform. They give you advanced execution and pricing, and some of the most dynamic charts you can find in the industry. You can open a basic account, a silver, a gold, a platinum, or become a VIP trader with FXVC. They offer you complete one-on-one training on CFDs. They give you analysis and market research. They give you risk calculation, money management skills. You have access to their economics calendar. You have candlestick analysis, you get technical indicators and price patterns. So everything you need to be a successful trader from their education department. They also push reliable signals directly to you through their platform. So if you want, during class tonight, you can go to www.fxvc.com and open a live account, and they have a whole special promotional package for clients that open a live account or begin a live account during tonight's webinar. And you get lots of surprise bonuses by opening up your live account. Now, FXVC is a regulated provider, and therefore I'm required to give you a risk warning. So let me read that and we'll get that out of the way, and then we'll go on and get ready for tonight's class. Trading in the financial markets may result in the loss of your deposited funds. Please ensure that you fully understand the risk or seek independent advice if necessary. FXVC provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided during this webinar is for educational purposes only. Now, FXVC is a regulated provider under CISIC license 238-14, and if you cannot access their website at www.fxvc.com, means that they don't offer trading in your local area because they are not regulated. They only offer their platforms in regulated countries. Now, tonight's class is being recorded. And if you wish to see a recorded version of tonight's class in about 24 hours, you can use the same link you used to attend this evening's class. Or you can see an edited version of this class on investing.com after they've had time to edit and clean it up. In fact, there you can see all the classes we've ever given. But remember, FXVC is one of our leading sponsors, and they're sponsoring this class, and they offer an incredibly great platform and a great trading environment. Now, if you go to investing.com, you go to the education tab and then look for webinars on demand, and you'll see all the webinars we've ever given there. So let's get started discussing risk management, one of the most important concepts any trader can have. Now, in tonight's class, if you notice on your screen, there are several handouts I put together for you. Please download these now because they're not available after this live recording. They're not available in the recorded version, and they're not available anywhere else. Well, you can contact FXVC, and through their education department, they'll get you what you need, and they'll also hook you up with a one-on-one analyst to help you get started trading. But please click on those download buttons right now, and there's the trading guide. There's everything you need to know about CFDs and how do you trade CFDs, what you need to know before you start trading, and that covers a great deal on risk management. And the CFD trading guide, which talks about how you would trade CFDs, how you'd manage your money, and how you'd manage your risk, as well as several strategies that'll help you get started. So please download those now. Also in tonight's class, I've prepared some special short presentations for you. These short presentations are not re-recorded in the webinar, in the recorded version of the webinar. You'll see them tonight. But if you want to see them separately at a later time, if you go to YouTube and don't do a search, look for the channel that's called Forex and CFD Education, and then look for the playlist that says Risk Management, and you'll see all of those little presentations that I prepared for you. So please click on the download button and download those handouts that are available for you now while we're getting class ready. Now in tonight's class, I'm going to use the term security, but I might say Bitcoin, I might say cryptocurrency, I might say stocks, I might say Apple, I might say Facebook. But really what I'm talking about are all assets that are traded in the financial markets. It's just, it gets very boring saying security, security, security over and over again. Also, I'm going to intermix the terms investing and trading. Now, you and I both know the difference. Investing is a lot different than trading. Trading is a short-term strategy to make short-term profits, and investing is a long-term philosophy, and it's investing. But either way, these techniques will work in either case. But I intermix the terms just again because it gets very boring saying trading, trading, trading over and over again. Now, it may sound like I'm going to lecture you, and I don't mean it to be that way, but too many traders pay very little attention to really what we want to call risk management and just want to trade. They spend so much time developing their strategies and trying to read candlesticks and trying to understand what MACD is and trying to find out what asset's going to move at exactly what price. They spend very little time dealing with risk management, which is more important than any trading strategy. Because we all know that you're not going to trade 10 trades and have them all successful. You're not going to trade and get 8 out of 10 successful. Maybe if you're really good, you get 50-50, you get 50% successful. Well, if you minimize your risk, that when you have these losing trades, that you get out of them gently, so that when you have the positive trades, they offset your few little losses and leave you profit, because ultimately it's all about profit. So many novice traders begin trading without a trading plan. And this is one of the primary reasons why the vast majority of new traders lose money. And I'll tell you, every time I get people in class and they say, you know, I started trading, I lost everything in a couple of weeks, and you know, this is all not right. And I try to say to them, why? What did you do? Well, I knew the euro was going to go up and I traded, or I knew Facebook was going up. Facebook shot up, but I lost my money. I said, yeah, but did you ever measure the volatility of the market? Did you ever filter down to see if you could actually afford to make that trade? Did you actually take into account that Facebook's bouncing up and down $2 today, and you can't afford that $2 loss, so you put your stop loss at 50 cents, but you would have known right away you would have gotten stopped out because it just, the swing in the market was bigger than that. So even with a trading plan, if the plan lacks a good risk management component, regardless of how well the plan may work initially, a trader can eventually or will eventually lose everything. So strict money management and risk control is essential to achieve long-term success in the markets. And if you figure that your risk-reward ratios and your risk management will filter out a lot of trades that you should not be making. And what we're ultimately doing between using our trading strategies, using our risk reward and our money management strategies, we're trying to filter out every high risk trade and only end up with low risk, high probability trades. Okay. And the fact is the market offers thousands and thousands of trades. There's an endless number of trades to make. But what you want to do is end up only making the few trades that offer you the highest probability of success. So strict money management and risk management control is essential. The high level of leverage available to traders makes it important to manage risk exposure and to avoid over-leveraged positions. Now, when you trade with FXCX, you automatically get leverage as allowed by CISIC. And leverage today is strictly controlled, but leverage allows you to ramp up your trading, which also ramps up your potential losses. So successful money management aims foremost at the preservation of your initial trading capital. So leverage can be defined as the amount of trading position you can control with any given amount of margin. Margin is only the deposit you are required to put down to make that trade. It isn't the value of the trade. So you can have a small amount of cash in your account and make a much larger trade. And everybody says to yourself, oh, well, look at that. I can put $500 in my account, but I can trade $5,000. But they just don't stop to think that as well as it ramped up your position in the market so you could reap better profits, it also increases your risk potential. And so everybody says, oh, it's easy. I can make $1,000 real easy. And they don't say to themselves, I can also lose the same $1,000. And risk management is all about understanding for whatever your potential profit is, you have the same potential loss. So how do I reduce that potential loss? Now, in practice, a leverage ratio of 50-1 means that you can control $50,000 worth of a position for $1,000 on deposit. That sounds really great, doesn't it? That means you could buy 50,000. Well, I don't know what Apple's. Let's say XYZ stock is selling for $10 a share. That means you can actually have a CFD worth $50,000 with your $1,000 account at $10 a share. You're tying up 5,000 shares of XYZ company. If XYZ company goes up $2, how much money did you just make? 10,000 bucks. But if XYZ fell $2 and you had taken a long position, you would have the potential of losing that. So while professional traders generally trade using the credit lines that banks and their counterparties extend to each other, retail Forex traders like you and I, and all the traders on FXVC, master this concept of leverage since they are usually required to trade on margin rather than on credit. You know, granted, if you have a couple $100,000 to shove in your account, then you can just trade on your account. But why? You know, it's like if the euro is going to move 10 pips today, that sounds like a big move. But a currency virtually doesn't move much in a day. 10 pips is 4 decimal points over to the right and gives you 10. So if you had 1,000 euros, you just made yourself 10 bucks. Well, that wasn't even enough to cover your spread. So you need leverage in order to make your position large enough. So naturally, this high leverage ratio can act as a two-edged sword, since losses can accumulate as quickly as profits. And I know I keep reiterating this, and I'm going to go over and show you some of the keys shortly, but it's very important you understand this, because this is why I apologized earlier. I'm not lecturing you, but this is so critical. You'll find out all the traders that last in the market is because they spend more time dealing with their risk and the reward and setting their targets and their possible losses and determining where their stop losses have to be placed and whether it fits in their risk reward ratio. And if it doesn't, they throw that trade out the window and go on to find another trade that will. Okay. So you might sort through a lot of potential trades only to find out that you filter them down, because it's all about this filter system, filtering everything down. Furthermore, traders need to keep close track of their margin requirements for open Forex positions, since many retail Forex traders will simply close out losing positions when a situation arises where the margin in the trading account has been used up due to adverse market movements. Now, the excitement of real-time, real live trading and the thrill of seeing an investment rise or fall can sway anyone. That's why finding an appropriate trading style and staying with it is crucial for risk management. Staying detached or objective about the investment while keeping emotions in check allows for the clear thinking required to make appropriate trading decisions. Keeping a neutral outlook as trading occurs allows a larger picture to be evident and ensures that the planned trading style is fulfilled without the bias of temporary changes or your emotion. Now, what are the most important rules? Number one, when losing trade after trade, lower your trading size by 50%. Trade smaller until a winning streak begins. Go even smaller if needed, and even take a break from trading. This sounds like ridiculous, but it happens to be that too many people try to chase money. So when you've had a bad trade and you're down, you've lost $500, you tend to say, oh, look at that next trade. I'm going to make a bigger trade because I need to recover the money I lost and still make profit. That's the world's worst thing you can do. You should say, if I had a losing trade, last trade, and I'm down money, I'm going to cut my position size by 50%. Because as I said, even if you have 5 out of 10 trades that are going to be good, 5 out of 10 trades are going to be bad, say you're better than most, you have 6 out of 10, 7 out of 10. You still have to get through those. Nothing guarantees you to get three one way, 3 the other, because it could be you need to do 30 trades before you get your 21 correct ones. So you could have 8 losers in a row. And if you lost $500, $700, won $800, before you know it, you wiped out your $5,000 account, and you're not even in the market when the market starts moving in the direction you had. So also only risk 1% of your capital per trade, never more. While this is standard, you must avoid the temptation to trade big to make up losses, as I just mentioned. This usually compounds the problem because the market is not cooperative with your style during a downtrend. 3, stay disciplined with your entries and exits. Do not get sloppy. 4, do not abandon methods. You have to stay the course. So when your method comes back in favor, you will start winning again. What it means is not every trading strategy works all the time. Sometimes the markets go risk off or risk on, and the markets get kind of crazy. Or if you're a good trader and you're only trading certain assets, sometimes they're just weird. You got to wait for some reason for the market to filter out its weirdness. Now, so don't abandon your method. You have to stay the course so that when your method comes back in favor, you will start profiting again. Don't take losses personally. It's not your fault that the market is not conducive to profits if you're trading your proven system. Do not fall into the temptation to let losers run. Cut your losses at predetermined stops, regardless of the pain. That means you have hardcore set rules of when you're going to get out of a trade, and each trade you have a hardcore set rule that you're going to get out way before when you enter it. All of these are determined before you enter a trade. And get out. Don't say I'm going to let it run longer because I know it's going to move in my favor. And do not stop tracking your watch list for the markets you trade. Be ready to trade the right entry when it presents itself. When it presents itself, when you've been able to filter everything down and you get one decent trade. Many traders get so beat up on a string of losses that they stop focusing on their watch list and stop trading high probability entries. Now, I'm going to tell you a little story here, a personal story. Now, most of you that have come to my classes before know I'm an old guy, real old guy, and I've been trading for over 45 years. But back in my college days, a long time ago, I had to support myself when going to school, and I was a fundraiser for the Democratic National Committee. And I was pretty damn good at it, made a lot of money, because we were paid on commission. I eventually got moved to the big donor's desk. But the reason I was so good is one day when I first started, my boss came up and said to me, because he could see I was really annoyed because I wasn't doing too well that day. He said to me, you know, if you think of every time somebody hangs up on you, or every time somebody says no to you, or everybody says somebody, call me back later, just say it's one step closer to getting a positive result. And I kept that in mind. He said, if you think of out of every 10 calls you make, you're going to get one donor. All you have to do is think, well, damn, then I got to get through 9 bad calls, so I'm going to get that 10th donor. Just always shoot for that 10th person. Once you get that donation, again, shoot for 10 farther. And all of a sudden, I no longer got upset when people hung up the phone on me. Sometimes people would cuss you out. Sometimes, and this was way back before the big telemarketing phase and all this stuff. So it was landlines. There was no mobile phones. It was a whole different world. But when I understood that philosophy, I never got upset anymore. I would just, okay, ma'am, I didn't want to argue with them. Okay, ma'am. Okay. Maybe next time we'll call you back next week or next election cycle. And I would just go on to the next one. Same thing with trading. If you understand that a losing trade that you get out of following the rules you had preset is not a bad thing. It's just your step in the direction to reaching that next profitable trade. So it's very, very important. Now I'll tell you another story. Okay, and then we're going to get on to really some setups and how we can evaluate risk and look at some charts. But in 1982, that was a long time ago, I was an agricultural trader. I had my own account. The markets were a lot slower then. We didn't have PCs. We didn't have all the stuff we have today. You didn't have online trading. And I would sit in the pits. Actually, the pit in those days was in my broker's office because all your data came by ticker tape, and you had to be sitting in a broker's office. You were trading your own account to get the information. And I'll tell you, 81, 82, 83, 84, I couldn't do anything wrong. Every trade made profit. I was rolling in money, and I was fairly young, but everything was going well. Well, I kept increasing my lifestyle, but buying new house, new cars, new everything. And there was money in the bank. The suits got nicer, the shirts got nicer, the shoes got more expensive. 84, the world turned against me. I couldn't make a good trade if my life depended, even following the same rules I had used before, because what happens, the market shifted. And my strategies and everything I had been doing wasn't working yet. Well, then, on top of that, I started chasing my profits or running after my losses because I needed to now bring in so much money per month to cover my bills, my lifestyle, my expenses. And I couldn't take that money out of my trading account because then I'd have no money to trade. So by the end of 84, I was dead broke and back to where I was before 81. And I said, you know what? This isn't for me. And I left. I had my degree in finance. And I went on into business and never went back into that financial world of trading your own account. Because personally, I don't have the way to control my emotions. It wasn't my personality. But that's just a story. But this is how all of us can make mistakes emotionally, try to trade, to chase trades, and override their risk reward. Okay. Because we all get emotions. So online trading is set up to be a rather risky endeavor. I always encourage new traders to go easy on the risk as they get started. The system is somewhat, rigged is not the word, but it's somewhat slighted to encourage risky behavior because leverage does this on its own. So you have to set out with a plan to protect yourself. So make sure your trades are within the realm that you can afford. And I can't tell you what you can afford because everybody's different. And your risk reward ratio will be different, your money, because it includes not just how much you can afford, it's your personality, it's how much experience you have, how much risk you're willing to take. So the number one thing that you can do is manage your risk, is to never trade money you can't afford to lose. Sometimes people skip this one thing. It won't happen to me, but it really will affect your trading performance. If you're trading money you can't afford to lose and you can lose significantly or even face the threat of losing significantly, your decision makings will be compromised and mistakes will happen. In other words, me in 1984. The second most important thing is that you need to not let your eyes get too big for your stomach. Trade what you are safely able to trade. Don't expect to get rich overnight. Don't expect to make a fortune. Expect to make, if you think of each trade as a step in experience and knowledge, all you're going to do is get better and better and better. So this means that you shouldn't be opening $100,000 trades with a $2,000 account. There's no need to make huge percentages every day on your money. It's more important to make continuous percentages rather than large ones. Now, the ultimate rule you have to have is a stop loss. A stop loss is a type of order that does exactly what it says. It stops you from losing any further money from your account. Trades don't always go the way you expect. You need a parachute to cut your losses. The trick is to set your stop loss in a spot that you know the trade will reach if you are totally wrong with your trading idea. Now, a stop loss in the current CFD trading environment, trading with FXCV, is XSVC is very easy. When you enter your trade, you actually just type in how much you're willing to lose and what level you want your stop, and it will the system will automatically close your trade at that level. Well, that's the easy part, telling the computer what to do. The hard part is coming to risk management, because you have to have two parts of your stop loss strategy. The first is, how do you determine where the stop loss should be? Say you're multiple rich, you got $1 million in your account. So how far down this can go isn't important, because you're not losing leverage. Okay. So where would I have to put my stop loss, or what price would I put my stop loss if I am completely wrong in my strategy, in my decision to trade? In other words, if Facebook is trading at 150 and I'm sure Facebook's going to go up, but Facebook turns around and comes falling down, okay, well, I know 145 isn't going to upset me, because that was within my realm of where the markets might bounce through before it turns up. But if it falls to 140, I need to get out of that market, because I am completely wrong. If you thought the Facebook results would be so significantly good, or what something hidden in that result would make the market positive, and it really didn't, or it didn't reach expectation and it started falling, you need to be able to get out of your trade. And you can't watch the markets every second of every day. So you need to put this stop loss in so the system will close out your trade when the market is gone against you. So the first thing is determining at what point will I say, I am wrong, I need to get out of this market. That's all your first decision. Okay, that's an easy one. Your second one is based on my risk-reward ratio, based on my money management, how much potential loss could I face that I can afford? See, 140, you'd be wiping out a good portion of your account. That's a $10 loss for you. And if you got 5,000 shares, that's a $50,000 loss. You and I most likely can't afford that. So what price can I afford to lose if necessary? Okay. Well, doing your calculations, you say, I can only afford it to fall to 147. Okay. Well, that means one of two things. Either you can't make that trade, or you got to take a much smaller position so you can set your stop loss down farther. But this is where your filtering capabilities come down, because when you filter it out, say, okay, I got to set it at 147, but the swing of the market's 145 and the potential could be 140. I can't make that trade. So stop losses should be considered to be your emergency exit. They should be set to execute when your trade has gone horribly wrong. I've seen many traders place their stop loss at a price where they might be wrong, or even worse, could possibly be wrong. If you set your stops too close to your price, it's going to get hit. It's Murphy's Law. Now, if you think about it, if you set a trade, if I bought Apple or Facebook at 150, set my stop loss at 145, took my target point at 160, okay, so it's 5 points against me, 10 points in my favor. That's a 2-to-1 risk-reward ratio. That's a little bit small. You should be at 3-to-1. Okay? But you're 160 and 145, and you get out of the market at 145, not because the market just happened to fall through that for a second, but because the market turned against you because the earnings report was worse, was not what you expected, and you got out at 145. That was actually a successful trade. And this is what you have to understand. Getting out of the market with your loss at the level that you had said was acceptable is a positive trade, is a successful trade, because that means you applied the right parameters and right rules. So managing loss is paramount for a Forex trader. Another key way to keep trading risk at manageable levels consists of recognizing when a profitable trade has run its course. This third risk management concept involves using a trailing stop to protect profits as a position moves in the desired direction. Many traders make an initial move of their stop to break even once 100 pips or so have been achieved. Now, a trailing stop loss also can be set up automatically on the platform. What it means is as the asset moves in your favor, it moves your initial stop loss, depending on what level you put it, farther and farther upward. So again, if Apple was trading or Facebook was trading at 150, you put your stop loss at 147, or say 145, Apple moved up, I'm sorry, Facebook again, Facebook moved up to 152. What happens is the system would automatically move your stop loss from 145 up to 148. Then if Facebook moved up to say 158, your stop loss would automatically follow it up, and your stop loss would be now at 152. So even if the market plunged, you would get stopped out at 152. That means you actually got stopped out at profit. So this is another way to apply risk management. This is why you have to have rules. I even have a philosophy, a strategy, where when an asset moves into profit, I'll sell half of my position. I'll move my stop loss up manually and just leave half of my position to run, because I've already locked in my overhead and my costs. Everything else is just pure profit. So moving the stop even further towards the present stop rate will further protect gains once a trade becomes even more profitable. Because the idea is when we have a profitable trade, make sure it doesn't turn into a loser, and also make as much profit as possible. In addition, trailing stops allow you to follow trends as they unfold for maximum profitability. When a profitable trade has run its course, perhaps by observing a set of mutually conserved technical indicators that point to a market reversal, an efficient trader needs to close out his position. Now, even though you set all this up in the beginning, you could change everything you put in with a trade. Okay? So you can move your stop loss up, you can move it back down. You can exit, you can decide, you know what? I'm happy right now. I see a little glitch, in my RSI, and I don't see the momentum I thought I would see. Look, close my position. You click on the close position button on the FXVC platform, and your position's closed with your profit. You don't have to wait till anything is hit. So remember, to put it all together, trading with money that you can afford to lose is the worst. You cannot afford to lose the worst scenario. Controlling your reasonable lot sizes, controlling your risk with stops will prevent you from having a major trading disaster. For many traders, too many traders take the Wild West approach to trading, and sometimes it works a while, but when it's over, it's really over. Trading while keeping your risk low will keep you in the game and put money in your pocket at the same time. Now, remember, speculating as a trader is not gambling, and this is what we want to do. We need to move you away from this gambling. We're not in a casino. We are in a very strict, very important business of making profit. And this is why we have guidelines, which is why we have rules. It's why we have plans and why we have strategies. We're not walking down to the casino and seeing, walking past the roulette wheel and tossing $10 up on 35 and walking away with $3,500 at the casino. No. But even a card player, such as a poker player, will employ either the mindset of a gambler or with the mindset of a speculator, usually with totally different outcomes. Now, I want to share with you, well, first, let's go over to the chart. Well, let me pop up a live chart because we talked about this enough. Let me show you some ways to do some basic. Actually, let me share with you first how you would set up. I got a little presentation on how you would actually do your risk reward basic calculation.
forextrading.com. In this video, we're going to discuss the risk-reward ratio because this is something that every trader needs to include within their money management techniques. Now, you may know or have heard of traders who generate more winning trades than losing trades, but still lose money. So their wins tend to be constant and frequent and are usually the same amount in every single trade. But then a single loss takes out either 2 or 3 of their winners, and in the end they end up in a losing position for the day. Now, one of the reasons for this could be that the risk-reward ratio is not correct. So what is risk-reward? In terms of its definition, the risk is obviously the amount of money you're willing to risk within a trade, and the reward is the potential profit target that you're aiming to get. So in terms of the ratio between the two, what is recommended? Well, professional traders recommend a risk-reward ratio of 1 to 3. So this means that your reward is 3 times the amount of that risk. So basically, if you lose once, you still have another 2 trades worth of winnings to rely on. In reality, a good risk-reward ratio to use is 1 to 2. So your reward is double of the risk that you're willing to put up in the market. So in terms of our calculation, the only thing that we need to do is divide the reward by the risk to see what ratio is relative to our trade. So let's say, for the sake of the argument, that our reward or our potential profit target will provide for us $100. The risk that we're putting up is $50. So if you divide 100 by 50, the answer is 2. So our risk-reward ratio is 1 to 2. So that means that our reward is double compared to the risk that we're looking to put up in the market. So let's look at a risk-reward ratio example in our chart. So the area that we're looking at is here. Okay, so what we're looking for is an entry just a few pips above this high here, and our profit target is somewhere that's relative to this previous high. So let's just define those by a horizontal line. So we got our entry here, which has been hit by this candle, and our profit target is just a few pips below the previous high, which is here, which has obviously been hit by this long white candle. Now our risk or our stop loss is going to be just a few pips below this low here. So we're going to take a horizontal line again and just put it a few pips below that previous low. Now you can see with the naked eye that our reward, which is this area here, is almost double the size, if not double the size, of our risk area, which is here. So we have 2 areas, the reward area and the risk area. So in terms of our calculations, let's say that our profit target would generate $100 when it reaches this profit line here. And unfortunately, if our stop loss is hit, we would lose $50, and our stop loss line is here. Now, if we do this on every single trade, all we need is 1 win out of 2 to basically be in a profit-making position.
So there are many strategies we can use to determine how we're going to put an entry point, where we're going to put our stop loss, and where we're going to put our target. As you saw in the little presentation, we were using the highs and lows from candles. Again, you could use Fibonacci retracement levels. You could use support and resistance levels. How you're going to determine these is part of your trading strategy and is ultimately important. But fortunately today, we have all these new modern charts, and you also have those on the platform that will do all the other calculations for you. So in this instance, we're looking right now at a live chart for the euro US dollar. Okay. And I've gone over here to my left-hand side to my prediction and measurement tools. And you also get this on the XFVC platform charts. And you click on your prediction and your measurement tools. I picked on a long position, and I simply came over here and I put it on the asset near the price I was going to enter. Now, I can adjust my profit and loss ratios to fit my trading strategy by simply pulling it down. Okay, and you see it's all being calculated for you automatically right under. So we've got our risk reward ratio now at 0 to 4, and you could set it to 25%, 2 to 1 is 50%, and you would set it here, and then you just simply, it's all your calculations done. You have to put where you'd have to put your stop loss, how much your risk would be, where you put your take profit point, okay, and based on your entry level. So you don't have to do anything. Now I'm going to show you this. I did this in a little presentation for you so you can see it live, step by step. But this is one of the easy ways to determine, once you've determined what your risk reward ratio is, once you've figured out what your target is, to drop the rest of it on your platform or on the chart. And this is not to do with where you would put your stop loss based on the market. This is where you would be putting your stop loss based on what you can afford to trade. Now, if your stop loss, if you wanted to put your stop loss below, say, the last low, you'd have to pull this down here and then pull it back up farther. So this is where you'd have to put your stop loss, okay, based on the chart. And then you'd have to see all of your other calculations because it's automatically recalculating everything for you. So here, let me show it to you in a short presentation.
And in this video, I'm going to show you the easiest way to calculate the risk reward ratio on any trade. So for example, I have open here the New Zealand Japanese yen currency pair chart. This is in trading view, and I'm going to go over here to the positions button, and I'm going to select a long position. So if I think this is going to be a long position, I can put my cursor here. I'll just click once. And now you can click and drag these zones according to where you think the trade is going to go. So if your stop loss is going to be below this candle, maybe you can stick it there. And then now you can see the risk reward ratio really easily here. So if you're just looking for 2 to 1, you can just bring it down to here and you can see the price up there. So that makes it really easy to see. I mean, sorry, that's not the price, but you can see the price over here to the right. So that makes it really easy to calculate your risk reward if you're looking for a certain R value. And you can, if you want, you can publish this to the community, or you can keep it private so that you can keep track of your risk reward ratios when you open a trade. So I hope that helps. And for more,
So once you've done your work as far as figuring out your entry and exit points, not your stop loss and your take profit points, but where your risk reward, what the possible downside is and what the possible upside is, as you saw in the first little presentation where you put your risk and your reward lines on your chart, then the rest is very simple. The system will calculate everything for you. So, but remember this, ultimately the 2% rule is very important. Never risk more than 2% per trade. Okay. We stress guideline because it depends on other factors besides your experience, like your trading system, and mainly how often it takes you to trade. The more currency trades you make per time frame that you focus on, the less you want to risk per trade. Also, don't forget to factor in changing market volatility and any adjustments to your entries and exits. Another way you can increase your chances of profitability is to trade when you have the potential to make 3 times more than you are risking. Okay, I always advise new or intermediate traders to always use a 3 to 1 reward ratio. 2 to 1 is not, unless you have a very large account, is not a successful enough strategy. Okay. Even if you're a newbie trader, maybe you go to 4-to-1 because all you're doing is filtering out trades. Remember this, you're only filtering out trades. So imagine, if you're not that experienced, you want a bigger filter. Okay, you want only those trades that you have high profitability potential. So in this example, you can see that even if you only won 50% of your trades, you would still make profit of $10,000. Okay. Now that's hard to believe, but it's true. Just remember, whenever you trade with a good risk reward ratio, your chances of being profitable are much greater, even if you have a lower win percentage. And if you can remind yourself constantly, this is not a game of how many trades you can make. I, in a whole week, might get in 5 trades, and I spend my days in the market. Okay. It's not a matter of how many trades I can make. There's always a trade. It's more a matter of filtering down. You'll find if you're looking at 10 different, say 5 different assets, and restricting what you're trading, you're looking at 5 assets. They're always going to offer potentials. If you filter them all out, you're spending your time filtering them out and throwing them in the trash can. So when that opportunity does present itself, you have a much better chance of being successful. And this is the big one. Setting large reward risk ratio comes at a price. On the very surface, the concept of putting a high risk reward ratio sounds good, but think about how it applies to actual trading scenarios. Now, the thing is, the higher you put your risk reward ratio, the more you're going to filter out, but the less possible trades you get. So never go more than 4-to-1. Okay, it gets too high, and what happens is you're ending up getting ridiculous numbers. You're getting, so 2-to-1 for an experienced trader, 3-to-1 for the average trader, maybe 4-to-1 to a newbie. So if you were to reduce your position size, then you could widen your stop to maintain your desired risk reward ratios. Now that's one way of being able to do this. If you were thinking about trading 1,000 shares of Facebook, maybe you need to drop it down to 500, because remember, you have several things in your risk reward ratio. It's a 2-to-1 or 3-to-1, but then it's 1% of your capital or 2% of your capital, and where you would need to put your stop loss. And so by reducing your position, because if your other money management rules, I'll never risk more than $500 or $300 or $200 a trade, you can, everything fits together. May take a smaller position size, a contract size. So instead of taking 1,000 shares of Facebook, take 500 shares of Facebook, because that can allow you to make your trade. So in the real world, reward to risk ratios aren't set in stone. They must be adjusted depending on the time frame, trading environment, and your entry and exit points. A position trade could have a risk reward as high as 10-to-1, while a scalper could go as little as 0.7-to-1. We're not either. We're not a position trader. We're not a scalper. We're a CFD or day trader. Okay, and we need 2-to-1, 3-to-1, 4-to-1. But risk is inherent in every trade. But as long as you can measure risk, you can manage it. Just don't overlook the fact that risk can be magnified by using too much leverage in respect to your trading capital, as well as being magnified by a lack of liquidity in the market. With a disciplined approach and good trading habits, taking out some risk is the only way to generate good rewards. So on that note, we're going to say goodbye. But if you want to learn more about risk reward ratios and how to properly set them, how to employ exit strategies, how to put stop losses, if you go to www.fxbc.com and open a real live trading account, you can use their education center, and you'll also get some one-on-one consultation with a financial analyst. And there you can develop the personal approach and decide what is right for you. So on that note, I'm going to say good night to everybody. Thank you very much for joining us. Thank you for supporting investing.com. And thank you for considering FXBC as your future trading platform. Good night now.